Hey guys, welcome back to the channel. I'm your host Sharwan and you are watching Ind AS by Sharwan. So in this video we will discuss about the difference between the existing accounting standard 22 and now the Ind AS 12, which is regarding the taxes on income, or you can say deferred tax. So this standard is very important and a lot of interviewer also ask you guys about the deferred tax, like what is the difference between the existing accounting standard and now the Ind AS. So basically three major differences there. First one is regarding the approach. So Ind AS 12 is basically the balance sheet approach and the existing accounting standard 22 was income approach. So we will discuss it later. And then the second major difference is regarding the recognition of deferred tax asset. So existing accounting standard 22 require you like reasonable certainty, and then the virtual evidence supported by the convincing evidence, a lot of stuff is there. So but now there is something change into the Ind AS 12. And then the third major difference is regarding the disclosure. A lot of disclosure is there into the Ind AS 12. One of the important disclosure is regarding the reconciliation between the accounting income multiplied by applicable rate of tax and then the current income tax which you recognize into the profit or loss account. So difference is there. So what I will going to tell you in this video is regarding the difference between the both two standard. I hope you will watch this video, very important. Watch the video till the end and stay tuned and just subscribe also this channel. Alright guys, so now we will start our video. Alright guys, so now let's start the channel. Alright guys, so now first difference and the foremost important difference is this. So it says like Ind AS 12 is based on the balance sheet approach. It requires the recognition of tax consequence of difference between the carrying amount of asset and liability and its tax base. So this is the very first important difference. It says like Ind AS 12 is based on the balance sheet approach, while existing accounting standard 22 is based on income statement approach. It requires recognition of tax consequence of difference between the taxable income and the accounting income. For this purpose, difference between taxable income and accounting income are classified into permanent and temporary differences. So let me show you how it is like balance sheet approach and the income statement approach. So this is the accounting standard 22, earlier accounting standard 22, and it says like timing difference are the difference between the taxable income and the accounting income for a period that originate in one period and are capable of reversal in one or more subsequent periods. So it's basically like income statement approach. So timing difference is the difference between the taxable income and the accounting income. So basically this is we can say it's on the basis of income statement approach. Now what's about the Ind AS 22? So temporary difference. Okay, we should first check out what is the definition of temporary difference. So it says like temporary difference are the difference between the carrying amount of an asset or liability in the balance sheet and its tax base. So basically timing difference here is the difference between the carrying amount of an asset or liability in the balance sheet and its tax base. So tax base is the new word which we don't know about it. And then like timing difference, the difference between carrying amount of asset or liability in the balance sheet and its tax base. But here under existing accounting standard 22, timing difference was the difference between the taxable income and accounting income. Now here the temporary difference is the difference between the carrying amount in balance sheet and its tax base. So we can say that it is a balance sheet approach, but we should understand like what is the meaning of tax base. So tax base is basically given into paragraph number 7 and then paragraph number 8. So what it says like this: the tax base of an asset, not the deferred tax asset but an asset. So tax base of an asset is the amount that will be deductible for tax purpose against any taxable economic benefit that will flow to the entity when it recovers the carrying amount of an asset. So tax base of an asset is the amount that will be deductible for tax purpose against any taxable economic benefit, and the tax base of a liability is the carrying amount less any amount that will be deductible for tax purpose in respect of that liability in future periods. So let me show you the tax base by way of example. So here's the example which I have note down, and you can see or check out that example in the link of this video, like the description column of this video. So temporary difference, we have seen like temporary difference is the difference between the carrying amount of an asset or liability in the balance sheet and its tax base. So we have also seen it into this one. Now tax base of an asset is the amount that will be deductible for tax purpose. Now what exactly is the meaning? So like machinery which has a cost of 100 rupees and depreciated rupees 30 depreciated of rupees 30 has been used for tax purpose, and depreciation of rupees 20 is used for accounting purpose. So now amount that will be deductible in the future period is 100, which is a cost, minus 30. Minus 30 means the depreciation which has been already used for the tax purpose. So 70 rupees will be deductible into the future period. So therefore the tax base of that asset is the machinery, is a 70 rupees. So now the amount that will be deductible for tax purpose is 70. 100 minus depreciation already used for the tax purpose, and the carrying amount of the of asset into the balance sheet is 100 rupees minus 20 rupees, which is like the depreciation for the accounting purpose. So carrying amount is 80. So therefore the temporary difference is the difference between the carrying amount of an asset in the balance sheet and its tax base. So here the tax base is 70 and the carrying amount is 80. So therefore the temporary difference here is the 10 rupees. So that's how tax base of an asset will be calculated, and the temporary difference will be calculated here. Now the tax base of a liability, we have seen into Ind AS 12. The tax base of a liability is the carrying amount less any amount that will be deductible for tax purpose. So like tax base of a liability is a carrying amount less any amount that will be deductible for tax purpose. So here's an example, like current liability include accrued expenses with a carrying amount of rupees 100. The related expenses will be deducted for tax purpose on the cash basis. So like current liability is the liability here, and it has accrued expenses. The carrying amount of that accrued expense is 100, but that expense will be deductible for tax purpose on the cash basis. So like carrying amount of the accrued expense is like 100 rupees, and then less amount that will be deductible for tax purpose when you will pay it on actual payment basis, like 100. So therefore tax base will be nil, because tax base of a liability is a carrying amount minus any amount that will be deductible. So carrying amount is 100, and the amount that will be deductible in the future period when you will pay on the actual payment basis is 100. Therefore tax base will be nil, but the temporary difference is the difference between the carrying amount minus tax base. So therefore in this case temporary difference will be 100, which is the carrying amount, minus the tax base, which is says like 100. So basically like the concept is same. If you will check out this example by applying the principle earlier, so answer will be same. Like the temporary difference would be 10 in this case, and temporary difference in this case would be also 100 when you will apply the principle earlier. Like we have accounting standard 22 in which they says like deferred tax or temporary difference, the difference between the taxable and accounting income. So basically just the language is slightly different. It says like temporary difference, the difference between the carrying amount and its tax base, and now you have the tax base of asset and liability. The answer would be same, but the method or the language is slightly different. So I will suggest you that don't confuse with the tax base or the carrying amount. Just apply the same principle which you used to do earlier. The only thing is this, like the language is slightly changed. And then if you have like, if you know the temporary difference, like temporary differences, now temporary difference is classified into two categories: taxable temporary differences and then the deductible temporary differences. In the taxable temporary difference, you have to calculate the deferred tax liability, and in deductible temporary differences, you have to create deferred tax asset. So taxable temporary difference, which are temporary differences that will result in taxable amount in determining the taxable profit of the future period. Like therefore in these cases you will have to create deferred tax liability. And the deductible temporary differences, which are the different temporary differences that will result in amount that are deductible in determining the taxable profit of future period. So in this case you have to create deferred tax asset. So like this, deferred tax liability are the amount of income tax payable in future period in respect of taxable temporary differences. Like taxable temporary differences, you have to create deferred tax liability. And in case of a deferred tax asset are the amount of income tax recoverable in future period in respect of deductible temporary differences, and this is the deductible temporary differences. So in our example, what are the taxable temporary differences and then deductible temporary differences? In our example, this one is the taxable temporary difference, because 10 rupees is the amount like because of which you will have the taxable amount in determining taxable profit of the future period. So 10 rupees is the deferred tax liability in our case, and then here the 100 rupees is the deferred tax asset in our example. Just the language is changed, all the thing is similar, so don't confuse it. So that is the first major difference. Like the approach is different, like asset concept, like balance sheet concept is there. Earlier it was the income statement approach, so nothing changed, just the language is slightly different. And then the next difference, which is also very important, is regarding the recognition of deferred tax asset. So earlier accounting standard 22 says you, like, except in the situation stated in paragraph number 17, deferred tax asset should be recognized and carry forward only to the extent that there is a reasonable certainty that sufficient future taxable income will be available against which such deferred tax asset can be realized. So there should be reasonable certainty that sufficient future taxable income will be available against which such deferred tax asset can be realized. And when you have the carry forward of losses, then there is also another paragraph, which is paragraph number 17, which is says, like, where an entity has first delete it. So where an entity has unabsorbed depreciation or carry forward of losses under tax laws, deferred tax assets should be recognized only to the extent that there is a virtual certainty supported by the convincing evidence that sufficient future taxable income will be available against which such deferred tax asset can be realized. And then you have the explanation of virtual certainty regarding it. So like explanation was there where it explain you what is the meaning of virtual certainty, but when you can say you have the virtual certainty. And there is also example like a profitable binding export contract, cancellation of which will result in payment of heavy damage by the defaulting party. So that is a virtual certainty in case of a deferred tax, like reasonable certainty should be there in case of a deferred tax asset, and virtual certainty supported by the convincing evidence should be there in case of a unabsorbed depreciation or carry forward or losses in which you want to make the deferred tax asset. And now under Ind AS 12 there is no such thing like reasonable certainty or virtual certainty. So Ind AS 12 says you like a deferred tax asset should be recognized for all deductible temporary differences to the extent that it is probable that taxable profit will be available against which the deductible temporary difference will be utilized. So it is simply says that it is probable that taxable profit will be available against which the deductible temporary difference can be utilized. But earlier it says you that there should be a reasonable certainty, but now it says like it is probable. And in case of a carry forward of losses, paragraph number 34 is there in the Ind AS 12. It says a deferred tax asset shall be recognized for the carry forward of unused tax losses and unused tax credit to the extent that it is probable that future taxable profit will be available against which the unused tax losses and unused tax credit can be utilized. The same principle like probable, and also in paragraph number 24 probable was there, but in this case like reasonable certainty is there in case of a deferred tax asset, and in case of a carry forward of losses virtual certainty supported by convincing evidence, and then you have the explanation of virtual certainty. But here that is simply say you can recognize the deferred tax asset on the normal deductible temporary differences, and in case of unused tax losses when it is probable that future taxable profit will be available. And then there is also paragraph number 35 which is says like the criteria for recognizing deferred tax asset arising from the carry forward of unused tax losses and tax credit are the same as the criteria for recognizing the deferred tax asset arising from the deductible temporary differences. So criteria for recognizing the deferred tax asset in both the cases is the same. However, the existence of unused tax losses is strong evidence that future taxable income or profit may not be available. So existence of unused tax losses is the evidence that the future taxable profit may not be available. Therefore, when an entity has a history of recent losses, the entity recognizes a deferred tax asset arising from the unused tax losses or tax credit only to the extent that the entity has the sufficient taxable temporary differences, or there is a convincing other evidence that sufficient taxable profit will be available against which the unused tax losses or unused tax credit can be utilized by the entity. So in case of a recent history of losses, you should recognize the deferred tax asset on the unused tax losses or tax credit only to the extent that the entity has sufficient taxable temporary differences, or there is other convincing evidence that sufficient taxable profit will be available against which the unused tax losses or tax credit can be utilized by the entity. But here under existing accounting standard 22, the deferred tax asset creation was slightly rude, you can say, like you can only recognize when there is a reasonable certainty and then the virtual certainty in case of a carry forward of losses. That is the second difference. I think it's a theoretical difference, but it is also very important difference which the person like the interviewer can ask you into your when they will test your knowledge. Now the third important difference is regarding the disclosure. So under existing accounting standard 22, there is a tab like presentation and disclosure. So paragraph number 27, 28 and 29 was regarding the presentation, and just the paragraph number 30 was regarding the disclosure, and simple disclosure was there. But under Ind AS 12, lot of disclosure requirement is there, like disclosure paragraph number 79 and then 80, then 81, then 82, 82A. So disclosure requirement is large, so you can check it out by your own. But one important difference like disclosure is there, like paragraph number 81, then clause number C, it says like you have to disclose an explanation of the relationship between the tax expense or income and the accounting profit in either or both of the following form. So like you have to also give the explanation of the relationship between the tax expense and the accounting profit in this form, like a numerical reconciliation between the tax expense and the product of accounting profit multiplied by the applicable tax rate, disclosing also the basis on which the applicable tax rate is computed. So now you have to give the reconciliation between the tax expense and the product of like accounting profit multiplied by the applicable tax rate. So whatever will be the figure like accounting profit multiplied by applicable tax rate, and then the difference of this amount with tax expense, you have to give the reconciliation. So here is an balance sheet of some company in which I find it really cool. So that's how they made the reconciliation, like reconciliation of this, like profit before tax as per the income profit and loss statement. So their profit before tax was this, and then applicable tax rate was this. So like profit before tax multiplied by rate, will be like 590.79, and the tax expense recognized during the year by the company was 489.33. So difference between these two, like accounting profit multiplied by tax rate 590.79 minus the current tax is 101.49. so this is the difference. So now the reconciliation would be like this. So this is the item due to which there is a difference of 101.46. so basically all these item like this: exempted dividend income from overseas subsidiary, expenditure on corporate social responsibility, all those are like a permanent difference, like donation not allowed in income taxes, area based tax incentive, share based payment not eligible for tax deduction. All those differences is the permanent differences. And one more important fact, under Ind AS 12 there is no such concept of permanent difference, like explanation or definition is not provided into Ind AS 12, but under existing accounting standard 22 the explanation or the definition of permanent difference was there. So you have to also give the disclosure of the reconciliation between the product of accounting profit multiplied by applicable tax rate with the tax expenses recognized during the year. So reconciliation is like this. The link of this document is also given in the description of this video. So with this this is the end of this video. So basically three major, I'm saying you major, not all, three major differences like this. So first one, Ind AS 12 is basically about the income statement approach, like in which you are doing like income Ind AS 12 is like the balance sheet approach in which you recognize the difference between the carrying amount of an asset and the tax base. Second major difference is regarding the deferred tax asset, like virtual certainty, and then the reasonable certainty was there under existing accounting standard 12T2. Now under Ind AS 12 it simply says like the deferred tax asset can be recognized in which there is a probable that future taxable income will be there. And then the third one is regarding the disclosure requirement. Disclosure requirement under Ind AS 12 is huge. So one of the major thing which I recognize is the explanation of the relationship between the tax expense and the accounting profit, like reconciliation is there. So this is the major difference between the Ind AS 12 and the accounting standard 22. Alright guys, so this is the end. I hope you find it really important or really useful. If you like the video, then like this video and also share this video to all your friends who are confusing like what is the difference between the existing accounting standard 22 and now the Ind AS 12, and subscribe the channel for more update. And I have also made another video like on the Ind AS 109 financial instrument, and then the property, plant and equipment, cash flow statement, and lot of also video will be there in this channel. So make sure you subscribe and also share to your friend so that they can also connect with this channel. Alright guys, so now we will meet again in the next video. Till then, bye bye.